clearly the Fed has stopped thinking about employment for the time being and focusing entirely on inflation. As your colleague just pointed out, the core PCE projection has been raised by more than 100 basis points in the span of 3 months. That is pretty seismic by Federal Reserve projection standards. So we are going to have significantly higher than 3% core PCE even as we end the year 2022, a far cry from what Janet Yellen and Jay Powell were transmitting to the market just a few months ago. So from that perspective, fighting inflation is imperative. Every meeting going forward is live. Quantitative tightening is coming. But at the same time, and this is an important one, is that the shock absorption capacity of the U.S. economy with respect to higher interest rates seem to be ample. I mean, that's the message I'm reading from Chair Powell and the Federal Reserve Board members. Higher interest rates will lead to real interest rate going to zero in real terms, then perhaps even head toward perhaps 1% in real terms by the end of 2023. That's okay for an economy that is likely to grow by more than 2% this year, next year, and perhaps even in 2024.
All right. What do you make of the comments that Will was making about the importance now of getting detail on the balance sheet process and where Jay Powell wants to go with that, and the historical relationship with the S&P 500?
I think the balance sheet issue is of paramount importance if the economy is so fragile that some degree of liquidity withdrawal would lead to massive spikes in bond yields, would lead to major correction in the asset markets because the asset market is standing on an edifice of leverage. Is that the case with the U.S. economy today and the U.S. markets? I think the answer is a partial yes, not an emphatic yes. Of course, the last 2 years, quantitative easing and historically low interest rates have helped capital markets, particularly the property market. But at the same time, the sort of run-up we saw around the sort of COVID stocks, if you will, or the sort of flight to safety we saw at the beginning of the pandemic, I don't think had anything to do with what the Fed was doing. It was just the overall sentiment of the market. The sentiment of the market is decidedly much more constructive today, given how tight labor markets are, how strong corporate profitability has been. Signals from the overall geopolitical context, whether it is with respect to inflation or overall fear of where this Ukraine conflict goes, those things will temper expectation to some extent. But generally speaking, we're talking about a bullish backdrop.